Hey, this is Brant from Wolf on Wall Street Trade with a market update for the week ending January 25th, 2019. I have a daily chart of the S&P 500 with a yellow 50-day moving average, a blue 200-day moving average. So we ended the last week's video over here Friday. It was a holiday shortened week. Over the weekend, got some bad macroeconomic data out of the Asia Pacific region, and US markets gapped down here on Tuesday. Found some support at the 50-day moving average on Tuesday, Wednesday, and rallied up a little bit on Friday to close the week absolutely unchanged. S&P was down 0.25%. The Dow was up 0.1%. NASDAQ 100 and the Russell 2000 were dead flat, 0% change. Transports were down almost 1%. There was some movement in global markets after the ECB. The MSCI All World Index, excluding the US, was up 0.5%. EEM, emerging markets, up 1.5%. And FXI, China 25, up 2%. And we left off last week's video looking at the S&P ascending wedge. So let me pull that up. So let's take a look at where we ended the week and how this week went. This is where last Friday ended, actually right there. So gap down. I had basically two calls on the market this week of what I thought was going to happen. The first was I thought that since we're breaking this ascending wedge, I thought that the S&P would test 2615, which is this trend line right here, which was close to the 50-day moving average too, but that's not why I came up with that. Here's a 15-minute chart. So on Monday, we had this gap down, and basically it was just a measured move. So it looked like this. Just kind of measuring from where we were to this first early morning action, and it was really bearish price action actually. And then there's the measured move down to 2615. Massive volatility crushing from about noontime at both of these lows right here and here. And then the other thing I thought would probably happen was a retest of the underside or a back test of this trend or of the ascending wedge, and or a fill of the gap from last Friday to Tuesday's open. Came down 2615 and right up here to 2670. That's why the S&P was just unchanged on the week, but just really brutal, nasty price action. I don't like markets like this a whole lot, and that's just the nature of an ascending wedge. I mean, let me demonstrate it this way. If I draw a trend line over here, right, of just kind of like how big this range is as we start it, and then another one up here, right, and then I'm just gonna take these out and show you. So that's the trading range early in the wedge. This is the trading range late in the wedge. So I think Wednesday in a market update I described it as being stuffed into a washing machine, put on the spin cycle and loaded with forks and knives. And to be honest, a lot of this price action was on these just continued news stories coming out for trade wars, contradicting news on that. The government shutdown, Chinese stimulus on Friday, a Wall Street Journal that the Fed is considering halting the runoff of their balance sheet, which would be a big thing, but I addressed that in some posts. So you know my opinion on that, but we'll find out on Wednesday. Here I've overlaid the VIX index in white just to show you a little bit of the price action. So on Tuesday, VIX actually surges over here, and it's difficult to see it on this chart, but right here at these 50-day moving averages, or at that test about 2615, volatility was being crushed from about noontime on both days. And in fact, here's a 2-minute chart of the S&P on Friday and VIX. As you can see, the S&P never got above this kind of morning range over here in the afternoon, but volatility just starts leaking off into the afternoon. Over here you can see it just starts crumbling as the market's kind of drifting lower. So again, not as bad as what we saw earlier in the week, but volatility coming under pressure. Here's a daily chart of the VIX. So we talked about this last week, coming down about 50% from the December highs. And here it is Friday relative to the previous Friday, down about 2%. So not a huge change there. I mean, I'm not saying the volatility smashing is as bad as it was, but it was definitely there intraday. Notice that since October, this is a 200-day moving average. VIX has found support right along that 200-day moving average. What I was talking about towards the end of the week is that we have the Fed, the FOMC, On Tuesday, they begin the meeting. On Wednesday, the policy statement comes out at 2 p.m. And what I've long noticed is that volatility is suppressed a couple days before and right into that meeting on Wednesday. Now, the example I was giving about this week for members on the site was that in December, let me just back up this chart of VIX. So in December, the market's selling off really bad, right? And here's what the S&P 500 looked like backed up to December 19th. So the S&P 500 is breaking below this range over here, right? Selling off. And then VIX just will not cross above 26. So here's VIX, and here's this range between about 16 and 26. Will not cross above that. This is the day of the December FOMC, December 19th, right? Everything said that VIX should be up in probably the mid-30s, would not cross that. As soon as that FOMC meeting ended, right here, this day, here's what happened. Point being, I expect that volatility is probably going to remain somewhat subdued into the start of the week with the FOMC on Wednesday. So if we look at VVIX, the volatility of VIX, we closed out the previous week down here. Okay, that's near a 2-year low, so just extreme complacency. And this is Tuesday of this week. So this is up about 14%, I think. Tuesday, the market got really pessimistic. Sentiment kind of went really nasty negative. So they're putting on their hedges Tuesday, and this kind of drops off to about, up a little bit on the week by Friday. I do think the market is getting to a really overbought extreme, and however you want to define that, whichever indicators work for you, I'll show you what I'm talking about. I showed this last week. So this is a daily chart of the S&P 500, and this white line is the percentage of S&P 500 stocks that are above their 50-day moving average. And what I pointed out last week was during that December sell-off, that got down to this extreme low down here at like 1.5%. So like 1.5% of S&P 500 stocks were trading above their 50-day moving average. Okay, and then we ended last week up here around 69%. Now keep in mind the S&P is actually down 0.25% for the week, just call it unchanged. But this has jumped up from about 69% to 75%. So we went from extremely, in my opinion, historically oversold to now probably what I would call extremely overbought. And there's one other thing I want to show you real quick. Here's the S&P with a NYSE new high, new low ratio. And if you look at Friday here, it's pegged up at 100. So it's like at the top of the range. I think the market is, one, very overbought, but I think sentiment is very skewed and a little bit neurotic. So I was commenting on this on the member site through the week, how the sentiment was changing, and I mentioned the put-call ratio. This is something a little bit different from NASDAQ.com. I think it's called IC, the IC index. It's basically like a put-call ratio, except it's long calls divided by puts. So above 100 is bullish and below 100 bearish sentiment. So here's what's interesting and what I called out on Wednesday as far as the put-call ratio went, was that Wednesday it dropped down to this very bearish sentiment, which is 55 here. Now that would be the most bearish it's been since December 21st at 52. And by Friday, it's up here at 146, which is the most bullish it's been just 2 days later since November 30th at 151. So a really big swing, going from ultra bearish sentiment on Wednesday to ultra bullish sentiment on Friday. I'll show you what these other dates look like just so you can see on a chart of the S&P 500. Okay, so here it is. I'm going to zoom in a little bit, just give you some reference here. So the most bullish sentiment was right here on November 30th. Okay, so that's right before the G20 trade war resolution. We had a lot of false breakouts right here in quite a few sectors like semiconductors, regional banks, stuff like that. Anyway, so that was the really high reading. And as far as that really low reading from December 21st, that would be right here. In the course of a couple days, the market went from the most bearish reading, sentiment reading, right here. And 2 days later, it was the most bullish it's been since right here. So just some really extreme swings on a week that the S&P didn't move. So what we have is a market in a counter trend rally. Here it is. And why do I say that? Because our trend is still down. We have these lower highs, lower lows, counter trend rally. This is what I would call reversion to the mean. It's up to the 50-day moving average, but it doesn't matter. The concept just holds. As a matter of fact, this is a really old charting software. It's like from 2007, but the reason I still use it is because I can go back and look at stuff like the Dow in the early 1920s. So let me show you something real quick. Here's the Dow Jones Industrials from 1929. You can see right here is where it starts. I'm just going to walk this forward. And I have a 50-day moving average here in yellow and a 200-day moving average here in blue. And I'm quite sure that nobody was looking at 50-day and 200-day moving averages back in 1929. So let's see what happens. Go up to the record high. Market sells off, right? I can zoom in a little bit closer here. And it reverts with a counter trend bounce or rally right up to that 50-day moving average. Then it breaks a 200-day moving average. Again, I don't think anybody was paying attention to these things back then, and sold off really sharply, right? And what I've always said about counter trend rallies is that they usually start in a bearish environment anyway. They usually start with some kind of impulse from central banks or from governments. So we got this huge counter trend rally. Watch this thing. I think it's about 5 months long. And it's about a 50% gain, goes up to that 200-day moving average, and then turns down. And I'll walk this forward a little bit faster so you can see what happens. 1931, 1932, and into 1933. And here's what this looked like in retrospect. So there it is. There's that kind of reversion to the mean. Now, look, I am not saying that this is an analog for the current market. I'm just saying that reversion to the mean, that's not a new concept. As far as the 2007-2008 analog I featured in a couple of videos, a little bit different at this point. Here's the S&P 2007. That is the bull market high, and this is the analog that I featured in a lot of videos. So first sell-off, kind of like October, a little bounce, a second sell-off, and then we went through a 6 weeks or so of consolidation, and the market put in this whimper rally here, sold off again. This would be kind of like what happened in late December, and then the market got some good news from the Fed. The Fed went dovish, and we got a counter trend rally. So that was not as extreme as what we have right now. As you can see, it fell short of this 50-day moving average, turned down. So that's a little bit different. This is where the kind of analog has changed. The current market has gone up more. But watch what happens ultimately with this yellow 50-day moving average. So reversion to the mean, ultimately it gets tagged, and then we retest the low. And if I zoom forward to the S&P now, we have tagged that 50-day moving average. But what I'm saying is that this is reversion to the mean, and that's pretty common, these face-ripping bear market rallies. So here we are back at a 60-minute chart of the S&P, and as I was saying last weekend, it's no different now. We have this bearish ascending wedge. It's actually broken down, attempting to back test over here. We filled that gap, unchanged on the week. And I still think this is a lot about flows. You had a lot of money come out of the market over here towards the end of the year, had to come back in, so you had some pension fund rebalancing, and there's just been these nonstop stories about trade wars and stimulus from China, which is a very real thing, and we'll see what the Fed does on Wednesday. The thing that I'm really looking for is for liquidity to reverse, and I started to see a little bit of that this week. So I have the 30-year yield here in white, and you know, if you've watched what's happened on this rally, other than this Apple scare right over here, you have the 30-year yield, 10-year yield. They're moving up with the S&P, which means treasuries are pulling back. And what I've been looking for is a reversal of that liquidity, because when people go out of treasuries, they can move into stocks, and then it switches. It goes back and forth. So what we saw early in the week was Treasuries started to catch a bid, and you can see that here with the yield starting to diverge from the S&P 500. So it's about a 3 basis point divergence in the 10-year yield, about 4 basis points in the 30-year yield. There's also some yield curve flattening. So one level I've said to, I would pay attention to is the 2s and 10 spread under 15 bips, under 14 bips. Then I think you're going to have a much different market environment. But these are the kind of signals that I'm looking for. Okay, so wrapping it up, the S&P 500 falls out of this ascending wedge. This is a bearish ascending wedge. Okay, it start to backtest the underside of that a little bit. And that gives you a weekly candle that looks something like this here. So you have momentum, 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 a loss of momentum, and we know that already from the S&P being down 1/4%, just unchanged on the week. Sentiment is getting frothy. Okay, we can see that in internals, we can see that in stuff like the put-call ratios, but it's also getting a little bit neurotic. Okay, so the market is really just looking for the next catalyst to move, and it's kind of knee-jerking all around on these news stories, and when that happens in a really tight range, it can be a brutal market. We can see, some liquidity is starting to turn. So I haven't done anything new this week, haven't added anything, just being patient. In the meantime, we've got a big counter trend rally. We've got reversion to the mean. The point remains that this market continues to be in a primary downtrend here with lower highs and lower lows. My kind of overall base case scenario is still that we probably come down and retest these lows from December, but one thing at a time. So I will see you Monday. Have a fantastic weekend.